Hello, and welcome to my channel, The Entrepreneurial Mindset. My name is Jay Berman, and today's presentation is titled Essential Accounting Concepts, Episode 7. These concepts come from my book, Is Your Business Idea a Good Investment?, which is available on Amazon.com, Kindle version only. Go to the Amazon search bar, select books, type in my name, Jay Berman, scroll to my book to purchase. And by doing so, you support my channel and my work in entrepreneurship and business education. Thank you. So today I'm going to discuss financial ratios, which include liquidity ratios, profitability ratios, rate of return ratios, leverage ratios, and asset management. Again, I recommend you learn Microsoft Excel or Google Sheets to calculate these ratios yourself. So the first one is liquidity ratios. Liquidity ratios show a firm's ability to pay current liabilities using current assets. And if you remember from previous episodes in this series on accounting, assets to cash within 12 months are considered current assets. It's highly recommended that the ratio be 1.0 or higher. So to calculate the current ratio, you take current assets and divide by current liabilities. If it's 1 or higher, it means that you're generating enough cash to pay your payables, which are your current liabilities, which then become your expenses. Though not a ratio per se, you can also use the formula working capital, which equals current assets minus current liabilities. If your current assets are greater than your current liabilities, it shows that your business is generating enough revenue to pay your expenses. Next, we have profitability ratios. We'll start off with the gross profit margin, which is calculated by taking revenues minus cost of goods sold and then dividing that by revenues. Again, from a previous episode, remember cost of goods sold is only involves if you actually have products that you're selling. Otherwise, physical goods would cost of goods sold apply. If you're selling services, cost of goods sold wouldn't apply. So it would just be revenues divided by revenues, which again would be 100%, which is very good. An example of if you have a gross profit margin and you are selling goods, a good example might be revenues minus cost of goods sold, or revenues might be, let's say, 50% because your cost of goods sold is 50% of your revenues. Operating profit margin equals operating income, which stands for earnings before interest and taxes divided by revenue. Net profit margin equals net income divided by revenues. Next, rate of return ratios. Rate of return on assets, which is net income plus interest. Then you divide that by total assets. Rate of return on owner's equity equals net income divided by owner's equity. And the rate of return on invested capital is net income divided by both long-term debt and owner's equity. Then you have your leverage ratios. The most common one is called debt ratio. In other words, you take total liabilities, divide that by total assets. The good thing about the debt ratio is to show you how much debt is impacting your ability to pay your debt. So if the total liabilities is way more than total assets, then your company is considered has too much debt, has too much leverage. Debt to equity ratio, total liabilities over total equity. And then interest coverage equals earnings before interest and taxes, which means EBIT divided by interest. And this shows your ability to be able to pay interest on your debt. And the next is asset management. The higher the ratio means that the company generates more sales per asset. So let's take accounts receivable turnover equals sales divided by accounts receivables. In other words, how quickly are you converting your account receivables into cash? Average collection period equals accounts receivable over average daily credit sales. That measures how quickly in time you're able to convert your accounts receivable. Inventory turnover equals sales divided by inventory. How quickly are you turning over your inventory? Fixed asset turnover, sales divided by fixed assets. Fixed assets also means long-term assets. And then total asset turnover, sales divided by total assets. In other words, how quickly are you generating sales given the total amount of assets that you have, that you own, that your company owns. And that's all I have for today. This actually ends my series on essential accounting concepts. Any questions or comments, use the comments section. Subscribe to my channel for educational content about entrepreneurship. And I thank you for watching.